Hello and welcome. Here's a company with maybe a 10-15% kind of growth clip that they've guided for, but a very large order book. Nearly 4 times book to bill is what this one has. It's in the core infra space and therefore to a large extent insulated from everything that's happening global. And it's down maybe 30% from the highs. If you can pull up maybe the 2-year chart, will give you a sense that at one point of time it was a stock which traded around 350, 360. It's come off very sharply. Of course, there are reasons for that and we'll explore those reasons. But apart from that, as we always do, we try to pick up interesting stocks which could look interesting in this market. And you might want to overlook the near-term headwinds that we're seeing. And this is possibly one of those. In terms of the valuations, it trades at 16 times FY28, penciling in a 10 to 15% kind of growth clip for this year and next. And penciling in a very, very conservative margin versus what they did in the highs of FY24. So that's broadly the tilt in terms of the sum and substance of the story. Now let's delve in deeper. The first piece is, let's try and understand what the company is about. And it was incorporated in 2002. It's into infra, EPC, and does complex projects, especially where EPC is concerned. If we can quickly, yes, absolutely. That's the graphic I'm looking for. It operates in infra, EPC, and complex projects. And it's in the India infra and construction space. And that's where they basically currently have a tilt. Now, let's go more granular. Second order, try and understand what is the exact nature of the business. It focuses on roads, bridges, metros, tunnels, airports, renewables. On renewables, they are into even battery and energy storage. They're into power generation, and they're also into EPC contracts. So they're across the value chain there. In terms of the EPC, they virtually do design, build roads, bridges, tunnels, metros, all of the like. HAM also is what they do. That's typically in the road business, where they're a part developer, part EPC contractor with some fixed annuities. The tariff-based renewables is also what they do. I spoke about that. They build and own solar and storage projects. Transmission and distribution projects is also what they do. They do metro viaducts and stations. They do railway bridges, corridors, airport runways, industrial works, bus terminals, and they also do operation and management of a lot of these infra related projects. Now let me talk about what exactly is HAM, because that's really the critical part of what Ceigall does. And HAM is basically something that was introduced by the NHAI in 2016. It's 40% funded by the government, which is any project, say 1,000 crore, 40% funded by the government. So to the extent of 400 crore funded by the government, 60% is funded by the private player, right? Now, the 60% is paid by the government to the private player, but over a staggered period of 15 years. And that amount is paid as an annuity, of course, or a semi-annuity every 6 months or 1 year, and over a lengthy period of time, which is why you might have stretched working capital cycles when you have large government contracts that you're running. So that's the other piece that kind of gets built into a business like this when you're looking at it. And in terms of the HAM projects itself, they have no risk of toll. So in case vehicles don't run on the road as well, you don't really run that risk. So you don't have any upside or downside to the traffic on that road. But broadly, you're a pure play developer. This is just how the revenue model works. In terms of the order book split, 51% is HAM, 21% is EPC, 27% is tariff-based, and 1% is other projects within the infra space. In terms of geography, they have a large dominant, tilt towards Punjab and Bihar. That tilt is coming down, but at this point, it's still quite large. 30% odd is where the tilt lies in terms of geography. Now let's talk about the metrics and how the company has evolved over the last 3 years. You look at the growth has been stellar, right? It's been 45% revenue CAGR that they've done, so some very strong execution. But what you'll see is the bulk of that has come between FY22, that's the first bar over there, and FY24, where revenues have nearly tripled, right? Thereafter, it's been steady state, 10 to 15% kind of growth, and that's the guidance going forward as well, at least on the revenue count. But 45% is impressive, and therefore we give it a thumbs up. EBITDA has actually grown at 41%. You've seen a bit of a cool off with regard to margins FY24 to FY25. As you can see, the EBITDA number was flat despite revenue going up. You're also seeing profitability grow at 32%. So very strong tilt with regard to the past growth that we've seen. Can this continue? Does this stagnate? Does it be as is? We'll try and understand that better from management when we speak with them. FY24 was an outstanding year. And if we can pull out the margin picture as well, that'll give us a sense on what went about in FY24. You look at the margin picture, it was 17% margins. It's cooled off since then, 15% in FY25. For 9-month FY26, it's actually 13%. So you've seen a bit of a cool off with regard to margins, and management has said that that might likely continue. There you go, you can see that. 13% in Q1, but outside of that, it's roughly between 13 to 14%, that margin number basically. So we've seen a bit of a cool off from the highs that was expected, and we'll try and get a better sense as to how to look at this going forward. But that's the operational trajectory, the margin trajectory as well. I would give this a neutral because we still need to understand it better as to how margins are likely to evolve. Let me now talk about the book-to-bill, which is extremely strong, and that's again part of operational. You look at the book-to-bill, it's been consistently very, very strong, 3 times plus. We've got a very healthy pipeline, and what they've guided for is 5,500 crore of order book accrual in FY26. FY27, they're talking about a 5,800 crore order book accrual. So you'll continue to see that expand very, very likely. Now let's look at the balance sheet, and here's where a little bit of the worry starts. When you look at the book value, and what you'll see there is that it's got a book value of around 2,000 odd crore. But you look at the debt, and the debt picture is where you slightly more nuanced, because you've got all of those receivables sitting over there in the debt picture, and the debt currently sits at 1,341 crore at the end of H1 FY26. So that's something we'll try and quiz management on. You've got 300 crore of cash as well sitting on that balance sheet of theirs. In terms of cash flow, conversion has been very, very tough, because a lot of the cash flow is stuck in working capital, and that is what the management claims will continue to happen. We'll try and understand how much of the equity continues to get locked into working capital and how the future trajectory with regard to cash flows is, but you can see that. The picture is very, very evident on your screen. Of course, fundraising leading to some net cash flows, but outside of that, you're seeing cash flow continuously get blocked with regard to working capital requirements. Let's talk about the return ratios though. That's very strong. So because you've got a low equity base, your return ratios which were elevated at 33%, have cooled off to 19, but still it's above 15. So really, if you're an investor looking for an investment, you would want to look at the return ratio of 15% plus. And that's what this one is really giving you. Of course, you have to contextualize all the other things, but at least on the return ratio count in particular, it's a decent return ratio, but there's been a cool off. The question is, can it start to bounce back? And can they optimize the balance sheet to ensure that return ratios get pushed upwards? And we'll understand that because there are certain divestments that they're doing in terms of assets. In terms of promoter holding, that's the other concern to a certain extent. Promoters holding 75% is great, 50% is also great, but 82% means that they might have to dilute at some point of time. So that might also happen, whether through a fresh equity raise. That may be one of the really good ways to dilute for a company like Ceigall, because you've got all that working capital issue, might as well raise equity. But we'll try and understand from management how they see it. FI holdings are around 3%, DIs hold around 5%, ICICI Mutual Fund also holds some stake in it, but they've been reducing some of their stake over the last few quarters. And then you have the public, which is also holding shares. When you're looking at how analysts are viewing this, there are just 3 buy calls, 1 hold call, just a 10% upside. Really not something that enthuses us, given the kind of market that we've seen. We've seen a decent drawdown, right? And therefore, when you're looking at a small cap company, you would expect a better upside from there. At this point, we're not seeing that. Plus, it's a smaller company, and that's why it's less covered by analysts as well. So we'd be cautious here with regard to the upside as well as with regard to the potential, how analysts are viewing it. Now let's talk about the valuations, and this is where it starts to get a little bit more interesting. You look at the FY28 price to earnings, it's at around 16 times roughly. And this could only compress. I mean, this is the most conservative number I've taken. The 5-year average is also 16 times. The most conservative, based on certain assumptions, I've assumed a 10% growth for FY27, a 15% growth for FY28, a 13% margin number. So 14 would likely compress lower, is what I have assumed. Could likely be wrong. The debt and interest cost largely will remain the same, is what I am assuming. And of course, the 5-year average is largely the same. So we've given this a neutral on that count, but those are all of my assumptions built in. Now let me bring on board Mr. Ramnik Ceigall, who's the chairman and managing director at Ceigall India, to talk to us about how the business is playing out. Mr. Ceigall, it's always good speaking with you. Firstly, give me a perspective. H1 was a little weak for you this time around, and I know that there is seasonality. Viewers, just for perspective, generally in a construction business, if the rains come in too early or they extend to too late, obviously there's some delays in construction, due to which there will be delays in revenue recognition as well. You're confident of that 10 to 15% growth. You've spoken about it multiple times. Is it going to be 10? Is it going to be 15? Give us a sense.
Hi, first of all, good afternoon for having me over. Thank you so much.
Very good afternoon.
Good question. I mean, H1 is always weak because of the rainy season. And, a large part of the work was in Haryana, Jammu Kashmir and Punjab, where the floods have really affected us. And you've seen the third quarter results, which has actually shown the growth. We had about 19% growth from the quarter two. And overall, we have grown. And going forward, if you talk about 10 to 15% growth, yes, we always guide our investors 10 to 15% growth. We are targeting much higher than 10% growth, and we are on the same path. I hope that this due to the war, our bitumen supplies, LDU supplies, and this diesel doesn't affect. Otherwise, things are very much under control and things are going very well.
No. This is wonderful. You've kind of taken this conversation slightly off. Talk to me. With regard to diesel supplies and with regard to gas supplies, what are you seeing on ground? For how long do you think that if the war were to go on, will things largely remain unaffected for you? And at what point, maybe say mid-April, end April, mid-May, end May, does it start impacting your numbers? Give us a sense of that.
So right now, we don't have any impact. Everything is under control. Little bit, of course, the prices have changed, but that's all under control. And going forward, if it extends, which is not in our hand or your hand, anyone's hand, we don't know. But there would be some impact in the first quarter because right now diesel is available, bitumen is available. Of course, little bit of the price is increased, but availability is there. And hardly 20 days are left in this month, not even 19 days. So things are under control, things are going well. It's just if the war stretches, maybe there would be some impact in the first quarter.
In the first quarter, would you say that if the war were to go on till the first quarter, there'll be a 10% impact versus what you would have done otherwise? So
right now, to assess this, how much would be the impact would be not correct. This, I mean, by the end of this month would be the right position. We would be in a situation to tell you what exactly it would be.
Okay, and what if it were to prolong, say for the rest of calendar year 2026? Then what happens?
See, with everything, there is another way out. I really understand. I mean, we have seen the wars before also. So if this stretches, the government would plan something. Infrastructure projects are not going to stop. Infrastructure as the backbone of the country. It directly impacts the GDP. So I don't think the government has already taken things very seriously. We've already had about 2 discussions with the NHA officials and the top guys of the country, where they're already in discussion. They've made a nodal officer to make sure the supplies are intact. And right now it is intact. We're not facing any problem right now. So I think going forward also, government would have a plan B for everything, and it should not impact. Thank you.
Okay, right. I get your point. Now, of course, some part of next year's execution will depend on margins. But what gets you to that 15% growth? Next year's execution will depend on monsoon. I beg your pardon. But what gets you maybe comfortable with regard to a 15% growth? would it largely be reliant on monsoon, or are you confident to say that whatever the monsoon situation, you'll still clock a 15% growth?
So, good question. We are a growing company. We have learned a lot from our past, these be it monsoons or anything else. I would not say the failures. It's all act of God. So, in that way, what we have done is earlier, the company started from a very small state, which is Punjab. Now we are in almost 14 states. There are many states which are not impacted by the monsoon. And then we've added with total verticals with Ceigall is about 11. So it's not important that if there's a monsoon for the road work or the structure work, that will impact. We have renewable works, we have T&D work, and that's in a different part of the country where the monsoon timing is almost different. So this year we have a different game plan, and fingers crossed, it should not impact. And our growth story is very clear. Our ADs, we've already received 4 ADs in this year. So revenue visibility is not going to be a challenge for Ceigall. So I can see a good growth coming next year.
Sure. Okay. Give us a sense with regard to margins. They've come off from the highs. You've acknowledged that on various con calls. You also said that those margins were, it was a good period. There was favorable tailwind with regard to margins. Talk to us about where margins will sink towards. What is the realistic margin picture you're looking at? Because you're very vocal with regard to your EPC contracts. You do 11.5% margin with a 3 to 4% bandwidth for a bonus. Now, are those bonus elements built into all your contracts within your order book? Would you therefore guide for a 14-15% kind of margin number? Is that something we can expect?
So, I said before also, ours is a growing company. We always play with double-digit beta margin, which is 11.5 to 12%, which I conveyed you also. We try to take it to 12.5 maximum. Now, in terms of the bonus or money earned from other income, which is royalty or FDRs, this year you will see another thing, which is we are selling off our HAM assets. We've already sold one asset to Neo. We've already shared that on our exchanges also. There's a lot of money which has to come in by selling these assets. And the good point would be, you highlighted, I was hearing your entire conversation before also, that our debt levels, which is at 13 to 41 crores at the console level, will drastically go down. Because we are just not selling one HAM, we're selling 3 HAMs. With 3 HAMs, fairly good amount of equity is coming in the company. And secondly, about 825 crores of debt will be, kind of deleted from the balance sheet. So this is our target to take it by maximum second quarter of the next year. So things are going in a very good direction, good way. And the money which we are earning on an equity margin will come in a part of our other income. So in totality, our EBITDA margins will grow. So going forward, the things will be very good. A lot of equity will come, which is a fair free equity to put in a new projects. The new projects have started, new ADs are there. So new, revenue is not a challenge. Third is EBITDA margins is not even intact. It should improve.
No, so give us the breakup. So you've said around 800 odd crore will be used to pay off debt. Maybe I've not read enough, but give us a sense with regard to what is it that you're monetizing in terms of total quantum, so that we get a sense of how much of equity is coming in.
So broadly, the equity which is coming is around 450 crore by selling all these HAM assets, and the debt is around 800 crores. So once you sell these assets, 800 crore of the debt will be, kind of deleted from our numbers of the debt, which is 1300 crore. Of course, the new projects, the debt will come. These projects are, AAA rated projects like Motorboat Sadhuwali is a AAA rated. It's like almost like a sovereign. It's backed by a AAA rated NHA, and the equity IRR is more than 20%. So selling these projects is not a difficulty. We have already sold one. We've already have an expression of interest from about 4-5 companies, selling another 2 also. And by selling all these 3, so roughly 450 crore of the equity will be coming in next, say about 9 months. And 800 crore of the debt will be, kind of removed from our balance sheet.
Okay. So if I can pencil in, say, for example, for FY28, a 10 to 15% kind of growth clip, which you've guided for, hopefully at the higher end of the guidance, and if we can pencil in maybe say a 13-14% margin, is that something that can be reasonably penciled in? Because your debt will halve, will maybe more than half. So maybe your debt cost comes down from 150 crore, if I've understood or done the math right in my head, to maybe just about 50 crore. Is that the right way to think of how the business will evolve into FY28 beyond?
So let me just clarify. At company level, the debt is around 550 crores. And at HAM level, the debt is, which is 825 crores. And the debt which is in HAM, which is in SPVs, once you sell those SPVs, the debt is finished. And the company level, if you see, comparing it with the last year, 31st March, it has improved. It was around 645 crores. It has come down to 550 crores. Quarter on quarter, we are improving there. Our debt equity margin ratio is also improving. It's one of the best in the industry. And these SPVs, once you execute, you have to take the debt. This is only 40% what NHI pays during execution, and 60% is paid in next 15 years in 30 annuities. So if we sell these SPVs, the debt is gone, and the equity money, like for example, if I put about 99 crore in Malotobor Sadhuwali, in totality, since we have received the COD, and the equity now we are getting would be close to 2.3x. So we have made almost 2.3x on the equity. So the numbers which we are saying of the EBITDA margins, we are trying to achieve that and maybe better than that. We will be definitive on our numbers once the another two assets are also sold. For the first asset, we have sold it close to 177 crores. 100 crore was our equity, 99 crore. And we've already got some funds before also at the EPC level by diluting, and plus would be the arbitration awards. So we have already won arbitration awards close to 90 crore this year. And we have claims worth about 3,000 crore in the company, which we have against MORTH, NHI, and other departments of state government, which are at the 80 level, which is again going to add as a bonus in EBITDA. You know, that money will come whenever it comes. It'll go straight to that quarter, and the quarter will be seen as impact.
Right. What does this do to your return ratios, Mr. Ceigall? So that's the first part of my question. Second, if you can give us the economics around both power and T&D, which is something that you've been doing and which is a growing portion of the pie of your top line. Give us a sense of that.
So first, return ratios. Whenever we bid for any HAM or PPP project, we plan to bid it at 25% IRR. So if I go with my first project, which we have sold, which is Malotobor Sadhuwali, where our EBITDA margins from the EPC was intact. Now we have sold the project. So equity IRR, you would have seen, you know, it was more than 20%. So overall, the IRR on that project is more than 30%. So 25% at the time of bidding, but we have achieved 30% IRR on the project level. So this is how Ceigall works. We do a lot of value engineering. We do a lot of value engineering in terms of the finance also. So things are going very well as growing company. Whatever we have guided to our investors, we'll definitely have better results of that.
Okay. Thank you so much, Mr. Ceigall, for coming in and speaking with us and giving us that perspective with regard to Ceigall India. But that's unfortunately all the time we have. And viewers, thank you so much for tuning in.